Welcome to Just Think About It with Nadine and Ben. We're recording this episode on Thursday, February 6th, 2025. Before we start our conversation, we have two key requests. First, if you're enjoying our podcast, please subscribe via Apple, Spotify, X, YouTube, or your platform of choice, and make sure to hit the like button. Second, we appreciate any kind notes and feedback, and appreciate you letting your friends know where to find us. Well, today is going to be a great episode. We're welcoming Michael Harris. Michael's the founder of Price Action Labs, a 30-year market veteran as well, which I'm excited to get into. Across various asset classes and trading, has written 3 books and numerous articles. Michael has extensive experience in systems, I'd say system dynamics, building trading systems, software development, all across the board. And we're excited to delve into his vast knowledge of markets. So we're going to talk about markets today, systems, and philosophy. So I know Ben's very excited about that last point. So welcome, Michael. Thank you so much for joining us.
Thank you for having me. Well, no one knows enough about the markets, but I will try to go into some interesting topics today. Thank you.
And we appreciate, I know you put together some materials, but before we jump into them, can you please let our listeners and viewers know a bit about your background? So the wide array of experience you're bringing to the table, so they can appreciate your unique perspective on the markets when we delve into those slides.
Yes, I studied engineering, robotics, and I worked as a robotics engineer for a large company, Fortune 50. And I designed high-speed assembly robots for electronics. I did my master's in control systems, learning control, robotics, adaptive systems. At the same time, I was doing my PhD at Columbia. My PhD was initially on learning algorithms for control or robots.
Okay.
But then my advisor wanted to change to large space structures. Then they abandoned. It was so complex, they abandoned the field. And, at a certain point, I asked how long it's going to take for my dissertation. He said, maybe 5-6 more years. I said, no, goodbye. All my friends are working in Wall Street and they are making money. And I'm struggling.
You'd like to eat, yeah. You'd like to eat, yes.
Yeah, I think so. So I got a second master's operations research, forecasting, and financial engineering. And I worked in Wall Street. I was a fixed income guy. Basically, I was doing control optimization of bond portfolios, fixed income, math stuff. I was writing software and developing the programs. And accidentally, I knew I had a classmate at Columbia who he got married to a guy who was interested in trading futures. So he asked me, he knew nothing about math and programming. He asked me, can you develop a program, an algorithm to trade futures? I said, probably, I wasn't too interested. I said, okay, I will do it. So we sat down. I developed software for an algorithm. Don't get the impression it was anything too hard. It was breakouts and moving averages and some risk control, and we backtested and it looked promising. So we said, why don't we invest some money?
Sure.
So we traded this, and in a year we made lots of money. I have some clients. I said, no thanks, because I did some Monte Carlo simulations and we were lucky. With this thing, we can lose money one day.
Sure.
Actually, we can have a huge drawdown, like 30-40%, and who wants these clients calling you 3 o'clock in the morning? Now, I didn't only develop the strategy, I was also trading, because the other guy did. know how to trade. He was a market guy. So to give you an idea, futures trading is a full-time job, 24 hours a day. I was trading and I had this screen on the ceiling on the top of my head at night. And I was, I would open one eye and look at the currencies. Ben is, I was looking at this. If I see a good signal, I buy something for the day or for a couple of days, and then I close my position. I want to have this exposure for months. Like Trent Pollard said, I want to start a fund. I said, good luck, take the strategies. Because, if you give a strategy to 10 people, you're going to get 10 different results.
Right,
I'm telling you this right now, because even the simplest strategy. So I said, here is a strategy. I take my profits. I wanted to study philosophy of science. I want to get a PhD. Then I applied for philosophy of science. And then I also started working on data mining.
Okay.
Because that was my concept was I wanted to identify price action anomalies in the market, short term, and trade them. And it was a big thing. And I have tried this with real money for the Robbins Cup for a year. And I finished third with bond futures.
Yeah.
So I wanted to try this for myself, just to trade. And I started developing these programs, these algorithms for data mining. That's the transition. I started developing algorithms to identify short-term anomalies in price action. I wasn't interested in fundamentals. I have studied fundamentals and macroeconomics, but I didn't want to get into those because I had my own idea. So I started to do that, and I gave a presentation in New York City, Hilton Hotel in 2000.
Yeah.
And some people from Europe were very excited about this, what I call synthesis of trading systems. Instead of analysis, you develop a system and then you analyze it, you let the computer synthesize the system. And then I developed the first program, which is documented in various magazines. I was invited author to automatically discover trading systems from price action and generate code. What these LLMs are doing now, they generate code, but specific to trading systems.
And what time period
because
was
these people, yes?
What time period was this? Like, give us a rough...
That was the early 2000s.
Okay.
Yeah. So, because these people from Europe, they said, if you develop a commercial version, we'll buy. And that's how I started. Then I started Price Action Lab.
Great. Well, I don't know if it is helpful, but to jump right into it then but if you wouldn't mind sharing your screen, or I can do it for you.
Yeah, yes.
But maybe you watch this and then you can drive it. Thank you so much for putting some materials together.
Yeah, I appreciate it.
Yeah, that we can kind of walk along a little bit with your thinking on where we are in the markets and how you think about approaching to, as everyone, like at the bottom line, to make money.
Yes. The title is Market Dynamics, Investing and Trading. And before I start, I want to say this. Most people, they develop some technique, method, or algorithm, whatever you call it. It all means the same thing. They all mean the same. And then they try to analyze it. The best way to go about the market is to try to understand the market dynamics first, and then develop strategy. And this is what most people do the opposite. They do the opposite. They try to understand the market dynamics through their strategy. And then they try to find all the reasons why their strategy should or shouldn't work, instead of analyzing the market dynamics. So I have a disclaimer that I'm not an advisor, and there is no advice in this presentation, just to make sure everyone understand this. We have to start with this chart. This chart shows the S&P 500 index and the 1 lakh 252-day autocorrelation of log returns. Basically, what is this for people not familiar? You take the returns of the S&P 500 and then you log the returns by 1 day, and then you take the correlation. And this is the autocorrelation. And you have to understand, I'm trying to since in my blog, below each slide, I have a reference to an article. People can look for more details. What happens is there was a major regime change in the markets in mid-99.
Yes.
And actually, there were two major regime changes. There was a technical regime change, which this is what I'm talking about now. And also there was a fundamentals. A regime change fundamentals. Now, the regime change in technicals was that from extreme momentum in the 70s and 60s and 80s, the markets went into extreme mean reversion. And for the people that are watching, to explain this, because most people do not explain what they mean. Momentum in returns means that up days, there is higher probability that up days are followed by up days. And mean reversion means there is higher probability up days are followed by down days, and the other way. And this is what the people refer to buy the dip. So this is the buy the dip regime.
Yes.
Now this is so fundamental. I mean, everyone should take this chart. Don't take my chart. Make your own, please. In Excel, you can do it in Excel and hang it on the wall. Because this is what you are dealing with. You are dealing with a market that went from extreme momentum to extreme mean reversion during the pandemic.
Yeah.
And why is this important? We will see why this is important and how it has affected the ability of people to design strategies, to deal with the markets and profit. So this was a major regime change in the technicals. And now there's the question why it happened. I'm not in the business of framing hypotheses, but I can give some hints. Maybe it happened because in the late 80s there was a rise it was the beginning of algorithmic trading. So these algorithmic traders, they were astute statisticians. They knew math and statistics. So they figure out that up days are followed by up days with high probability, down days are followed by down days with high probability in the market. So they make programs to arbitrage. So this is what I call arbitraging out the serial correlation in the markets. Now, the greatest of all time, Jim Simons, he made a reference to this in the TED Talk. He said that trend following is dead. People ask him, why is trend following dead? Everybody said trend. So many people are trend following. He said it's dead because in the 70s, I could use a 10-day moving average to make money. And now I need the 200-day moving average.
Yeah.
Well, this is profound. and I will tell you why.
And
But before we go in,
one thing, I think that, there's a book called The Rise of Carry, and the authors argue that this whole buy the dip mentality, regime change started in Black Monday, 1987, and they show it through selling one-day gamma over buying 21-day gamma, and there's a clear, it made money, and then boom, it went the other way. And you can see it kind of on this chart of the blue and then the red, but it was very clear that
yes,
the way that they
right
argued.
here, very good observation. This is when it started, but we also have back here. You see, all these hypotheses are nice, but in the markets, we cannot test hypotheses because you cannot go back and test the hypothesis of 1987. So yes, I agree, possibly, but I think it was a multitude of factors that led to this fundamentalism change. Yes, Ben.
Yeah, I think it's more like, I agree with you, right? Because it's just a part of the empirical record. I think you're pointing more that that's when it did change. That was like the changing point, not why it changed necessarily.
Yeah, not why. Yes. I agree 100%. So let's see what happened in the fundamentals. Because it was a regime change. You see the total public debt. You guys probably know that Clinton balanced the budget in the late 2000s, in the late 1990s. And then we had the dot-com crash. So over here, they balanced the budget. But then the market crashed, and I will talk a little bit more about it. And then they understood that the stock market needs rising debt to go up, deficit spending, investments. So here we have after the 2000, the debt is increasing, and then during the financial crisis, it takes another turning point, higher trend, and then another higher trend after the pandemic with the deficit spending and the fiscal spending.
And I think one of the things, sorry to interrupt you, but one of the things, and you can see it probably right there actually, I was just going to say this, is that a lot of people would argue that the new monetary regime we have started in 1994 when China came on. And, I know me and you have talked on Twitter, and I have a lot of charts that show all the markets kind of just revolve around that peg. There's winners and losers, but
yes.
China.
Yeah, I have many articles of this and videos in my channels about the impact of the Chinese peg from 1995 to 2005, around 8.3, and how that created the imbalances that caused the 2008 financial crisis. But you know,
we don't have time for that. Yes.
That we can discuss this for 5 hours,
right?
And all that. So the trade deficit, from basically very little in the 1990s. We have, of course, there was during the financial crisis there was a huge recession, and they kept going, kept increasing.
Yeah.
And the CPI, you see, during the period they balanced the budget, it was almost like became flat, but then it took off again. And the only meaningful drop in the CPI was during the financial crisis. The price level. This is the price level. And then, if you draw the line here, you have the trend, you have a new uptrend. It diverges from the trend due to the inflation after the pandemic. And and the increase in the money supply. So these are the fundamental changes.
And
Ben,
do you think, because, there was another change in the sense of before the GFC, almost all the credit creation came from the private sector, the banks, right? And then post GFC, because the Fed balance sheet was like, I don't know, 750 or 800 billion prior to the GFC. And, the debt to GDP of the US was, I don't know, it was like 40% or something. It was fairly low. And then obviously that was another regime shift in the sense that private credit creation kind of stopped in essence, and they were just kind of in the rollover business. And then it was all public debt creation. So the credit creation continued. It was just a different sector in essence that created it, which created some different dynamics, right? Little less credit cycle sensitivity, I would say.
That's a point. There is a change in dynamics. So I have a chart here. Now, dual axis charts are questionable.
Yes, I agree with that.
To say the least. But
you can make them match up, right?
yeah, you can match. You can match. But here we're talking about similar things. And we're not trying to find a correlation. But if we look at the S&P 500, the red line, and the public debt, we can see some possible association. And some people may dispute it, but I think there is an association. Like in 2000, when they passed the budget, the public debt went flattish. Over here, the market dropped. And then due to the financial crisis, after they started again the quantitative easing, the market again. So, but I went into this in another podcast about AI. The reason this is happening is that the United States market is what is driving it up is speculative investments, basically. There is no investment in traditional markets. So you have like the stock that is paying the highest dividend in the US stock market is Altria Group, tobacco, 8%. I mean, the yield of Altria is almost equal to the annualized return of the S&P 500. But NVIDIA, on the other hand, the yield is like 0.03%, but it's driving the market up. Why? Because it's a speculative investment in AI and technology. So technology and speculative investments, they drive the market up for good reasons, and sometimes these good reasons, they create a bust. I'm not going to get into this another 5-hour talk. So let's see specifically now how market
there it is,
dynamics
1987. There we go.
Yeah, have changed. Exactly. Now, Jim Simons, the greatest of all time, he talked about the 10-day moving average. Well, what you see here is the equity curve of a hypothetical strategy that goes long the S&P 500 when the price is above the 10-day moving average, and short the S&P 500 when the price is below the 10-day moving average. Now, this is not a strategy because, first of all, before the ETFs, you couldn't do this easily. You could do it by designed a portfolio of a few stocks. They used to call it tracking portfolios that track the index together. I use this strategy to study market dynamics. So what happens until as Ben said, until 1987, this strategy had the amazing performance, and then it just stopped working. So there was a significant regime change, and I have details in an article I wrote in 2016. My God, time flies, guys. Time flies. 2016, and I have the link here. Limitations of quantitative claims about trading strategy evaluation.
Yeah.
So basically, the idea is that it doesn't matter how much you drive with statistics to prove that you are right, the market makes a regime change and drives you, and destroys your strategy. Now, what about the long-only strategy? Well, by the way, this chart is in linear scale, and you can see that it was almost total recall until today. I mean, whatever you made, you lost.
Yeah.
Wow.
If you continue doing this.
Can you do this in reverse? Like, would it work if you're like, hey, I want to short when it's like above the 10-day moving average? And
well, that's mean reversion. So that's what I said. Momentum worked. Very, very good observation. Momentum worked, and then when the serial correlation changed, mean reversion works.
Yeah.
Yeah.
Yeah, and it's interesting because, going back to the sell 1-day gamma, buy 21-day gamma, you see this work, but then you have these little blips of carry crashes in essence. So
yes.
Carry regime is such that this is the money-making strategy, and then people use leverage on it, but every once in a while we get these breaks, and then these guys who run this strategy all have to sell at the same time, so we get these sharp sell-offs followed by grinding higher, right? Isn't that kind of and we see it, look, just the last 2 weeks, we get deep sea market crashes or whatever.
Crashes, but right. Vol event.
It was a vol event. Yeah. February 18th or December 18th after the Fed, there was a vol event. And both of them, in even this tariff thing on Monday, crash, grind higher. Crash, grind higher, right? Isn't that just, the underlying dynamics of what's going on, that's how it works now. There's so few.
Yeah.
Go ahead.
Yes, because before it was like a pure momentum, but now it's like mean reversion. It has small periods of momentum inside. So this is why you get these volatility events. So very good observation.
And one other thing to follow up on that real quick, some guys have done work, and there's more and more people who pay attention to the dealer gamma inventory, the option dealers, because obviously another thing that's changed a lot, and you guys have been around longer than I have, is the role of the options market has only grown exponentially, especially in the equity space, right? So there's a little bit of a tail wagging the dog dynamic. And so the theory is that when they're long gamma, it's a mean reverting market. And when they're short gamma, it goes back to they trade with the market, if you will.
But they are mostly long gamma.
Yes, I understand. That's why people pay attention.
And if I show you a chart, we cannot talk about everything, but I can show you a chart that options are almost always overpriced, except before crashes.
I totally agree. As a guy's walking around right now, and then everyone made a lot before crashes. You couldn't say that better.
Yes. So I mean, to make money with options, you have to have impeccable timing.
Mm-hmm.
Otherwise, you overpay these guys and to live in mansions. And I met them. One of them sold me a sports car. He said, we would charge a lot. So this is the long only, and this worked until 2000. And then it crashed, and after quantitative easing, it has recovered. Now, this is important. What I said, quantitative easing helped recover from a very ominous dynamic, the market, because if there was no quantitative easing, very few people would invest in the market. So, because most of the investors are long only, they do not short the traders. Short. So this has, and you see only recently it recovered the loss. But again, this strategy is to show the market dynamic. Another thing that changed, which is even for many people more important, is the stock bonds correlation. Now, some people will look and will say, oh, in the 90s, it was highly positive. And then it became anti-correlate. They became anti-correlate. And now they are again positive. But there is a huge difference. In the 90s, both stocks and bonds went up. By the way, this is the S&P 500 total return, the S&P 500, and the total bond total return. So the top chart. The difference is that after 2001, the correlation became positive, but both stocks and bonds fell. That's why it went positive. So it's not, that's why you cannot use correlations for asset allocation.
Yet. Okay.
No, yeah.
Yeah,
No,
yeah,
yeah, it flips. It flips, the correlation flips. So, yeah, you have to know what regime you're in.
And if you look, the mean correlation is zero. And you think that bonds are, Google look at the system, the 60/40, Google look, the few minutes.
One thing,
the
can I just
correlation is
for a
zero.
second? Isn't correlation what blows up, like long-term capital management? It was bad correlation assumption that blew them up. And like guys try to hold these correlation assumptions, and it's always the same thing. The correlation flips on them, and that's a bad situation when you're using leverage, right?
Well, I have heard about 10 different theories why LTCM failed. One was Russian bonds. The other was they used the Kelly criterion. The other was that correlations failed. I'm not sure why they failed. I think there was, who can summarize and say they were simply over leveraged, and someone estimated the leverage to about 73.
But yes, but if you're okay, just to use it for trading system, you're making an assumption about the correlation of the trade they're running, and then when you use that kind of so it's definitely the leverage that blew them up. That is definitely it. But when you run that leverage and you're holding a correlation assumption, it's. I mean, we saw this summer. If you looked at the implied correlation 1 month or 3 month of the S&P, it got down to like 6 or something or 7, and it was all those guys doing the dispersion trade. And then all of a sudden something happens, and then there's, yen carry trade unwind, but it could be anything. And then, they all kind of get unwound. And
yes,
I mean, the pod shops, that's what they do in essence. There's just these huge volatility sellers till there's no meat left in the bone, if you will.
Well, my point here with this chart is that correlation is not very useful for let's see the impact of change in market dynamics. Stock picking became much harder because from a value-oriented market, the Occidental Petroleum, IBMs, you remember those big names, the International Paper? No one knows. If you say these names to a young investor now, they say, "What is this?"
That's
Are you
not
kidding
true.
me?
IBM has actually had an unbelievable run for the last year.
Well,
But they've been on
for
the
a
sidelines
while,
for a long time. So your
for
point
a
stays.
while, for a while, so stock picking became much harder because in the past, in the 70s and 80s, it was about value stocks and there was momentum. Now, the technical chart analysis, these guys that do head and shoulders and
Yeah, yeah.
and
We know one of those guys. We know one of those guys.
and it stopped working, but it was always an illusion that it worked. The reason it worked, and I have some articles on it. It was because of the high serial correlation, and after it switched to mean reversion, this chart patterns and technical analysis stopped working. Momentum, like before I show you a price series momentum strategy or hypothetical on the S&P 500 with 10-day moving average. Now people are using 200 days, and they call this momentum, or they call this trend following. It's something different. It's not exactly what Jim Simons or a trader of the 70s, a CPA of the 80s would call trend following. I call it something different, and I have been blasted for that. So calling it something different. But it's not. Technically it is, but it's not what these people call trend following.
Well, don't you have to give a much wider rope the longer the frequency? Like if you use a 200-day instead of a 10-day, you have to accept a lot more drawdown
exactly.
or volatility, right?
That's the point. That's the point. Yeah. That's the point. Exactly. And also your exposure to market events is more frequent. Well, I wrote an article that passive investors are trend followers with a 700-day moving average. Well, here you go. I mean, the price never crosses, so
Yeah.
you can consider those are trend followers too. Well, and then people said, okay, but look at the chart; it always goes up. And then we had the tremendous rise of the passive investing. How much is it, Ben, now? About 60% is passive investing.
It's a lot. Yeah, it's over 50%. So it's significant. Over 50%. Yeah.
And everyone said, oh, okay, we just invest and we keep sending checks, and because markets always go up. And we will talk about this shortly. Market timing became there because of the negative serial correlation. And we had, and people said, how are we going to deal with this? Oh, we're going to do strategic 60/40 or tactical allocations. Because, we go back to the previous chart, stocks and bonds are not correlated. So bonds will provide a hedge if stocks crash, which didn't happen in 2022. And this, is problematic from now. I mean, I wrote an article in 2017 in Seeking Alpha that the 60/40 is a risky portfolio, and so many people attacked me.
Well, that's how it is when you're early on things, right? Especially something
Yeah, because, and I specifically wrote that we never cut stocks and bonds falling together. And if this happens, the the investors who lose a lot of money, now they say, look, it went up again. Yes, it went up again. But before we talk about this, and then we have performance winners, like from 2000, the peak of the stock market, to what about 2012? It took the total return about 12 years to recover the previous highs. And also in the CTA, they cut the lost decade from 2009 to 2018 because of these changes in the markets. So the effect of changing market dynamics, I like to talk about these things because every time you consider these changes, and the more you think about them, the better you understand what is happening. And there is no limit to how deep you can go to understand the markets. Like before the 1990s, we had stock picking. I have met stock pickers. Now, some of the young people play zero-day options. They have no idea who the stock picker is. It was a guy with a briefcase, with a lot of accounting material
Yeah.
inside.
10Ks, 10Qs, right?
Yeah,
I mean,
would basically
we had a guy, a friend of mine who is a stock picker, and I have a couple of friends who are still stock pickers, but he would tell you he kind of feels like a dinosaur. He thinks that the passive has gotten to a point now that it's actually the most inefficient he's ever seen it, because the passive creates inefficiency in essence. It's creating opportunities for stock pickers. And I remember them teaching that to me in grad school over 20 years ago. They're like, the ultimate limit math or edge math would be that if you had 100% passive, it's wildly inefficient. I don't know. Where are we at now? Like 55, 60 or something?
We're going to talk about this. These guys, they could even visit companies, have lunch with the founders, the employees, study, see what products they have lined up and everything, and decide where to invest the client's money. And they had a lot of flexibility, but of course the disadvantage was the specific risk of these companies. Something happens, and they drop a lot. They can drop like a lot, 50%, 80% in a week. And then we have the S&P 500 tracking. Now, again, young people don't know there was a huge industry in relative terms of people developing algorithms to extract a small subset of the S&P 500 that track the index. And why? To minimize transaction cost. And then you invested in those stocks only. And then you had to rebalance. So it was quasi-passive because there were no ETFs. The first ETF, the spiders, they came in January 29, 1993. Okay, so the SPY. So momentum and trend, basically CTAs and this group of very brave people who didn't sleep at night. So that was high alpha, but you need to have a lot of discipline. You had to follow the systems. If you didn't follow the systems, it was destined. They were destined to fail. And technical analysis was easy to learn. So many books. You remember those days. many books, but it was random. Now, after the 1990s, we had passive investments, do nothing. And of course, as Ben just said, high drawdown. We will see the charts. Strategic allocations, do nothing. But those failed due to regime changes, like the positive correlation of stocks and bonds while they were both falling. Instead of the 90s, when there was positive correlation, but they were both rising, and the 64 investors, they made significant gains. Tactical allocations. This is a higher Sharpe, lower DD, but you have to do market timing.
Right. You have
And
to
market timing is always a risk factor in the markets. One of the biggest now is the market timing and trading. Guys like me who didn't want to become fund managers. You have flexibility. Actually, you are more flexible than a fund. But you can trade anything you want, basically, as long as it is traded in an exchange. But you need an edge, and you pay multiples of what the funds pay that trade volume. So,
right. And
so
with trading, I mean, I think that's a good point. You know, as somebody who's ran books and been a trader for, you know, I started as a fundamental research analyst, but then ran money and was a trader. There's costs both from the transaction, because you're transacting a lot more. You have the tax costs, you have the slippage costs, and then you have I have a Bloomberg. I have to, you know, get some access to people. There's just to be an informational edge. It used to be easier and it's gotten harder, but you still there's like a minimum strike price of cost investment, I think, that you need to be willing to take, in essence, in order to make money trading. And so
it depends what you trade, but if you're going to trade futures, the minimum is 5 million.
Yeah.
If you're going to trade futures and have a good exposure, you need at least 5 million. Maybe you can do it for 1 million with the micro contracts now. But you still need good money. I mean, you need a good size account. Yeah, I agree. So trading, why am I talking about trading? Because there is a huge misconception here. There are so many people that they don't know what they are talking about. And I will explain. There are two types of trading, convergent and divergent. The convergent is the mean reversion. Price drops, as Ben said in the beginning. Oh, he saw it immediately. What about trading the other way? You know, drops from what you are considering an indicator. There are many types of mean reversion.
We have one, just so you know, Michael, and it works really well. So it's like, but you're right. You're collecting nickels and dimes and nickels and dimes. So you size it up or do it a lot, and you're just getting lots of nickels and dimes.
And then
but you're always at risk. Just so, in essence, mean reversion, you win. You have a very high win rate. You have negative convexity, and
low payoff.
What'd you say?
Low payoff.
Low payoff. Yeah, exactly. So that's when I say convexity, you don't make much money, but you win a lot. And then with breakout divergent, like, hey, the market's going to crash or the market's going to blow up. Like I'm buying Nvidia in March, even though it's up, like I know it's going to have this next leg. You can get really spectacular returns, but yeah, the discipline part is right. Like, and also it's very hard to know the difference in the real time, right? Like it's easy to look back at a chart and say, oh, I should have done this then, and whatever. We look at
timing is hard. Yeah.
Trade, like it's easy to say I should have traded the range if you look at a flat stock chart, until one day it breaks and then you give back all your gains from trading the range in
exactly
2 days.
Because it's high win. A typical reversion strategy is 65 to 70% profitable, the win rate. but the payoff is like 0.75. So, but many reversion strategies are compatible with the market dynamics right now. That's why they work. But you cannot use stops. If you use stop loss, you are destroying the profitability because you never know how they turn. And then you have the divergent trading, the trend following. It has a high payoff, like typically 5, 4, 5. By payoff, I mean the ratio of the sum of the winners to the sum of the losers. Okay? But you have to have discipline because now trend following works, as we said before, it's not a 10-day moving average. In the best case, if you are lucky and you work hard, you will use a 100-day moving average or a 100-day breakout. Typical used by CTAs is 150-day breakouts, and some use up to 350-day breakouts. So imagine what can happen in between. Now, what is the misconception? People say we'll do strategic allocations because we don't like timing. Wait a second. If you do a strategic allocation and you use alternatives like trend following, some poor guy is trading daily for you. You are not doing it, but someone else is doing it. And he works 24 hours a day. Without trading, there is no market, there is no strategic, there is no tactical allocation. Because someone else is doing the dirty job for you. And the convexity comes for strategic or tactical allocation, comes from someone who is willing to trade. And what does this person do? This person must find willing counterparties, parties who are willing to lose. Who are these people that are willing to lose? No one is willing to lose. Well, there are the hedgers. And those are in the futures market. Because they hedge production of grains, oil, even gold.
It's basically non-economic actors, right? Like to your
Exactly.
point,
they don't care if they lose because they make the difference. It's hedging.
Yeah,
and also
you see that in the options market, right? Our friend David Dredge is a tail fund manager, and he says it's always positioning, and he's looking for guys who are taking one side or the other of the tail, and the price gets off, and you get the implied, well, it's like all the profile of it gets cheap, and you know what? They need supply or they need demand on one side or the other, and I think that so much of macro is positioning and then finding those non-economic actors. In stocks, who's the only one? It's in essence, it's the company buying back their stock, right? That's the only equivalent.
They are not willing to lose in the stock market. Well, what happened in the stock market? What happened in the stock market is there were not people willing to lose, except a few uninformed speculators, but this is not a lot of money. So the central bank came in to support the market, and it was willing to lose.
Yep.
This is what happened. Now, both strategies.
Well, sorry to interrupt, but when you look at this, right, you've got your convergent and divergent trading strategies, and who has to be a counterparty, the type of capital you're talking about that needs to be there, the type of person that needs to do it. What's the trend in that? Do you see this being an area of opportunity, that there will be more traders out there, or do you think that it's going to get fewer and fewer? Or how do you think about the market for trading strategies?
Well, trading strategies is the race to the bottom. Well, what happens is, like for a long period, like after the .com, traders disappeared from the market. Now they invent products like zero-day options and ETFs 3 times, 4 times. Now they have 5 times to lure people in because they need the traders. And they always in the mainstream media, they blast the traders. Something happens in the market. Oh, it's the traders. and I don't know. This is a good question. I don't know what will happen. I don't think that trading has a good future.
Yeah, I mean,
Because
the argument that I've heard is that as the passive grows, that there's less alpha in the market in essence.
exactly.
And if there's less alpha and you're a trader, you're essentially trying to capture the alpha around the trend that is the beta of the market, if you will, or whatever. That you could just
it's
own
leverage,
The diversion trade.
beta. Leverage beta.
Yeah.
You leverage the beta.
Yeah.
And that's all you can do. And when people realize this, they drop out. There's attrition because they realize they cannot generate alpha. And also, due to technology, markets become more efficient.
You know what they do, Michael? They go sell subscriptions and books.
Well, that too, but selling subscriptions, it's not easy.
No, I agree. I agree.
Nowadays, people are quick hitting the unsubscribe if you are not providing value. Because I know.
We have a subscription businesses also, and customer acquisition's hard, and churn is high. So
I know, and you will notice, and tell me if I'm not right, that most of your people are around with you for many years.
Yes.
And my subscribers for the ensemble strategies I do, they are very long time, 5 years, and the new ones, they come, they don't understand what is going on, they leave. And mine are overseas, they are overseas investors, they are not paying taxes for the market timing, because the foreigners are exempt. Still, I think, when they trade the US markets.
Yeah,
from capital gains.
But just to look at the bottom of this, let's kind of like tie this up right here. It's like, I agree with you, and I've talked to Nadine about some trading strategy, like design stuff, and I've always said, we can do a back test over a time series, but I think that's worthless if you're not regime adjusting it. Like, hey, what were the returns?
You're gonna see the next slide.
Okay.
You're gonna see.
I beat you to it. Is that what happened?
Yeah.
I mean, you are a step ahead of me always.
I don't know about that.
Okay. Yeah, this is the back test, the S&P 500 index total return from 1990. And people said, no, these drawdowns, I'm not going to live with those. Because you have all these accounts on social media that say, the market goes up. 10.6 annualized return, but the Sharpe ratio is only 0.59. Oh, but they say stains, just be passive. Markets go up. And then you have this guy, Stefan Gassi, who did this. He has an excellent book, comics. Relax, the market won't crash. And even if it does, it will go back up. Of course, that market will consist of totally new investors. Yeah, and that's the problem with passive investing. I have written an article that passive investors in US equity markets are the worst gamblers. So people looked at it and say, okay, let's go 60-40. And this is a back test of the S&P 500 index total return plus 20 plus years year bonds total return. And everything went just fine until 2021, when they were hit with the positive correlation of both falling stocks and bonds.
Yeah, Michael, I'll tell you a funny story. I was at a client a couple days ago, and there was a guy from, I won't say which wealth management / bank, but it's one of the big ones. And he was explaining why, a stock bond portfolio is going to save the client. And I was like, do you not remember just a couple of years ago? Like, did you forget?
People don't realize how many people down here,
Yeah.
they sold in panic, and they haven't even invested anything. They have their money in T-bills.
Yes.
I mean, so people said, okay, this doesn't work. Or this may not work. The smart ones before. Let's try something else. Let's try a non-weather portfolio. The thing is all-weather.
Right?
Yeah.
Ray Dalio, he was overexposed to bonds,
right?
Like 15%. And look, they thought they were printing money until 2021, and they got hit with almost 20% drawdown. I mean, this is tail event.
But they were the same thing with like their correlation. They made a correlation bet that flipped on them, and then used too much leverage on that correlation bet, and then boom, got destroyed in 2022.
They could not think that ever bonds and stock would be correlated and both down. They said, no, will not happen. It won't happen. And then this is dead. This is dead, basically. If it happened once, it will happen again. I mean, this portfolio is dead.
And this is such a popular strategy in the risk parity. It became so much assets into it. And then obviously the 60-40 is the initial of this, right? But that's just like levered 60-40. I mean, it's weird because I think 2022, Nadine, you could maybe color on this, but I think the average retail investor was like, wait a minute, I'm losing on my bonds and my stocks. And it was just
and
like a
tech, and then people were like employed at tech companies. So it wasn't just that. It was also like, around here, their livelihood of the money to come, right? It wasn't just their portfolios, but the money to come, options underwater, that kind of thing. And that, I think, was a third element to the freak out.
Plus, the loss of purchasing power because of inflation. It was so terrible. Okay. So they said, okay. We know that over the long term, there is an alternative space, trend followers that are not correlated, zero correlation with the stock market. CTAs. And we're going to put 50% in the stock market and 50% in CTAs. Yes, it may work or it may not work, but you have to give back 4% annualized return. Because what happens is CTAs have so huge dispersion that the average, this backtest is with the SG CTA index, that the average compresses the volatility, but also the return drops substantially because of the dispersion. So the annualized return is about 6.6% as compared to 10% for the passive S&P 500. So this can make the difference between a comfortable retirement and eating cat food. This is an expression a fund manager used in New York City. He said to some people, do you want to eat cat food? Okay, invest in. So I think the the strategy may work. The volatility may be below 10%. It's theoretically has been around 9.3%. The drawdown may be less than 5%, but the returns will be
pressured.
this one.
Yeah.
Yeah.
So what do you do then? I mean, a lot of people here.
You guys, you
are so impatient. We're so impatient. My God,
He's
we're the
impatient,
worst.
not me.
Oh, come on,
You
Ben.
are said that both of you are amazing. That was the next slide. Are there any alternatives? Well, simple market time, but everything comes with a catch. Okay. What academics love? 12-month moving average. So the annualized return is about the same, and drawdown falls to about 22%. The sharp increases to about 0.75, 0.8. In 2022, it dropped about the same as in 190.90, but there is a catch. And I'm telling you, the system is simple. You buy when the price, SPY, for instance, you buy when the price is above the 12-month moving average, and you sell when it drops below. This strategy, and I have some articles on that. By the way, if you leverage it, there's tremendous leverage beta here.
Yeah.
However, this strategy has been lucky because all the recoveries from bear markets in the US, they had the shape of a V bottom.
Right, they just come right back up. So you're catching it. Yeah.
Now, if you apply this strategy in the emerging markets that went sideways from 2011 to 2018, it will lose 50%.
Wow.
Because the problem with price series trend following, this is basically price series trend following with a huge lag. 12 months is like, 252 days, 250 days lag. That type of price series momentum can get killed in a sideways market.
Yeah.
Because of the chop.
Which we think we're going to be in for the next year. We actually think
we've been chopping around for 3 months now, right?
Yeah.
Well, it may be for the next 5 years. I don't know. It depends, Let
me ask you that, Michael, because everyone likes to talk about what would change this dynamic of rising passive. How long do you think it'd have to take of the S&P, the SPY or the VOO or whatever, where all these assets are going sideways while underneath the surface active managers are, because there's a lot of rotations and there's things where, if you're in the right places, there is money to be made, especially, if you're doing it with leverage, where it makes go out of favor. Like, what do you think it would take? This is just a philosophical question.
If you read the article, A Hard to Beat Strategy, passive will not lose much money in a sideways market. They will not make money, but all the others will lose a lot of money. So passive will gain. If you want to destroy funds, and momentum traders, because as everyone knows, momentum is the only unexplained anomaly that has given problems to the efficient market hypothesis that fights the efficient market hypothesis. Why momentum is in the market? So if you want to destroy everyone and drive them out of business, you just go 5-7 years sideways. The passive investors, maybe they will lose 5-10% or even make some money. Very little. But all the others will get destroyed except traders.
Yeah.
and vol traders,
Right.
the good ones. So, simple market timing, weekly mean reversion. We use our algo here, the PSI 5. Now, the problem with mean reversion and trend follower is the huge optimization space. I have written some articles. So, there is not really one strategy, it's thousands of strategies.
Yeah.
So if someone tells you mean reversion works,
For
it's
what?
probably
Yeah.
selection bias.
Yeah.
Yeah, because it's too many parameters. So this is, again, this is a system this has lower volatility, 15%. You can leverage and get up to a little bit better than the stock market, but there is no guarantee it will work. It may fail any time if the dynamic changes, as we said before. Now we have a mini reversion. This is weekly, not daily. The signals are weekly. You trade at the beginning of the week, open, but may stop working anytime. What else? Futures trend following, huge optimization space. This is RL, 23 future contracts. Last year it had its best year since 1990. We are finishing now, 2 slides. So 14%.
Let me ask you this, Michael, because we had our friend David Dredge on who would argue, and we've done some of this math too. We have actually a convexity product, Nadine and I do, that being long, and maybe being long in one of these methods you just said that outperform, but then adding tail, and you have to be a pro to do it, right? Like that's the problem with it, is like, buying insurance for the average person for a home or whatever, it's easy, but buying insurance in the markets is not an easy thing to do. And there's not that many participants that, like, your average long short manager does it poorly, right? So you have to be patient. You need to go across different markets. But he's shown that over all these different time horizons, it's the dominant strategy of owning vol and owning more risk in essence. So that, because if you look at the distribution of like the returns by months, the most important are the tails. The top 2% and the bottom 2% explain like 75% of the return. You know what I mean? So if you're missing,
you don't know which months.
Well, I totally agree. Prediction's hard, especially in the future, right?
Yeah. 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 And you see this is future still following long short, okay? Because most of the money in the last, before the yields went up, trend followers made most of their money long bonds in the markets because of the falling yields. And this is having its best year, and this is just one system out of the thousands. This can also fail. It can stop working because also the universe selection. We were lucky last year we had Coco.
So Michael, I mean, some people will be very sophisticated investors listening to this, and it may resonate with their strategies and what they do. But then there might be, call it, average retail investors, and they say, well, gosh, this sounds kind of bleak. What do I do? So what would you tell people to do?
There are alternatives. Are there alternatives?
See, I like to set you up, Michael. I like to set you up to answer the question.
Daily risk hedge.
This is called perfect information because I looked at your slides.
Yes,
he's front random.
Front running you, Michael.
Yeah, if this is legal, front running is legal for
That's
politicians.
right, for presentation purposes, right.
For
Q&A,
politicians,
for Q&A
it's
purposes
legal.
only. That's right.
Yeah, daily risk hedge. Well, daily risk hedge, you can do it with various methods. The simplest is buying puts but it's a timing problem because if you keep
like you
buying
said, they're
goods,
expensive. You keep buying, buying, buying.
and
And
if you
then,
keep
yeah,
buying,
yeah.
there will be nothing left to buy any more
That's
food
right.
at the end. So you have to have some good idea when to buy this tail risk and how much you have to consult a professional
right.
advisor. And I wrote an article, Cash is the most robust equity portfolio hedge. You can find this,
Especially now where you get a yield on it.
Yeah, exactly. If you get 4%, why risking getting hit with a 10% drawdown? You can wait and buy near the bottom.
So I 100% agree with that. Cash is optionality, right? Stocks go down, you can buy more stocks with your cash. And I
in
think
that article, I say gold is not a hedge. The old weather, the 60/40, everything, only cash is a hedge, is a robust hedge. And puts, if you know what you are doing, but options are difficult.
Yeah, I agree. And I think one other thing that we should talk about with that it's impossible to hedge against liquidity with anything but cash or options. That's it. Those are your two: long ball in a convex manner or cash. Like those are the only, because how many funds like own, they're short and they're long. Well, what is their real position? They're short liquidity, right? Like, if you remember the summer of 2007, all those quants, like they blew up at the same time. And, smart guys, but they just didn't realize the crowded nature of their trades. And then they lose on both sides of their trade. And then they have to sell into a market where, at bad prices, then
there's no liquidity.
50% in a month or whatever the number was, right?
So these are it's becoming more complex and more challenging. And people, retail investors must have a very capable and knowledgeable advisor. And retail traders must understand how the dynamics have changed and what they can do, and what is the potential of the market. And I hope, my presentation provided some initial, for people who are not familiar. Of course, there are people who are familiar with these ideas and this material, and for others to look further, to try to understand what they can do.
Yeah, I think it's good though. It's like, understanding what regime you're in, understanding the system dynamics, and then figuring out how to make money with kind of those conditionals or those initial conditions or assumed initial conditions, I should say.
You have to understand the regimes and liquidity, as you said, and
counterparty risk sometimes.
Counterparty risk, like in trend following futures, it's easier because you can find hedgers who are willing to sell you the risk, and you can. But in the stock market, you don't know. You may be transacting against an insider. And in a book I wrote in 2008, it was published by Willie, and I'm giving it free to the people, to the people who subscribe to your channel.
Nice.
Profitability in systematic trading. They can download a PDF. I say in a chapter there that people prefer to trade Forex or futures because when they trade stocks, their counterpart may be an insider who is selling stock to buy a diamond ring for their wife. So you don't know.
Right. Why they're doing it, what's going on, right?
Yeah. You don't know what is happening. And also the earnings reports, you see the Intel and dropping like 20% and BA, they have some accident with the plane, they drop like 10% and everything. So this is my blog. You can get the free book. And this is how I have some channels, all of them free.
And for those
in
listening,
YouTube.
we will post it. He's got a slide on here. But his X is Mike Harris, New York, like NY. You've got your Substack, your YouTube. So we'll post this so people can find you.
Yeah. All this is free material. Okay, so Substack, I have markets and more. I speak. There is no subscription there, and it's a free YouTube. I have a common sense macro and quantitative and technical analysis. I get they are all free, and I have articles in Medium, so all free access about the markets and the dynamics and the strategies and everything else. So
thank you so much. I mean, I think that we're gonna have to get you back on because I feel like we've just scratched the surface with you here.
Yeah, we scratched the surface of this, but thank you for having me.
Yes, and thank you for sharing your wisdom with us and letting us know.
Sorry,
yeah,
go
and
ahead,
showing
Nadine.
people what doesn't work, right? So I think sometimes they hear from their wealth advisor something. Nobody can time the market. Just put in an ETF or a 60-40 portfolio and don't think about it. And I think it gives people something to think about who's in the market, how they're playing, how things have changed. And hopefully they can reach out to you or learn a little bit more through the many ways here that you've posted.
Well, don't email me.
No.
Just, you can look at the blog.
You know what I mean? But read what you're saying. So that's one way that people get to know it.
Yeah, thanks for clarifying this.
Because do not email her, call him. Yeah, or show up at his door.
Because lately I'm getting many mails from people who are a little bit confused about the markets and trading.
Okay.
And I'm trying to explain that I do not provide personalized advice this only a registered advisor can do.
Sure. Yeah. Well, thank you so much.
Yeah, thanks.
And
thank you, Ben. Nice to talk to you personally.
Yeah, it's just
nice to meet you, Nadine.
You too, Michael. Thank you.
And have a nice day.